Let me give a very brief presentation of each one of you, and of course we'll dive deep into the panel. I'll start with Patrick Artus on my left-hand side. Everybody knows Patrick Artus, Senior Economic Advisor at Natixis. And let me go then through Joseph Pinto. You're from M&G Investments. We have on your left-hand side, we have Mooki from Generali. And we have next to you Nakamura-san, who is from AM1 Alternative, Andreas Kalusche from Prime Capital, and last but not least, we have our dear moderator today, Sachin Patel, your Executive Director, Global Credit Syndicate at Natixis CIB. The floor is yours to introduce the panel.
Thank you very much, Christina, for the very warm introduction. I'm very privileged to be here to moderate what should be a very interesting panel on the different factors that are affecting the private debt markets. The private debt markets have grown to over 1 trillion euros and have really become a key strategic asset allocation for portfolio managers and their different allocation strategies. There have been different supply-demand factors at play, and this discussion is coming at a time when the market is very fragile, and there are lots of interesting things to kind of discuss. In putting together this panel, we wanted to have the views of some very large global asset managers and contrast that with some more specialist managers to really try to understand the nuances in the market. So I'd like to first hand over to my fellow panelists to introduce themselves and, importantly, explain the lens with which they look at private debt. And then we'll hand over to Patrick Artus to talk a bit about the macro side of the session. And then we'll focus on some more specific sessions, and including the impact of liquidity, regulation, the general fundraising environment, and then finally leaving the floor open to questions. Joseph, Neo, Andreas, Nakamura-san, Patrick, welcome. So I'll hand over to each of you, maybe starting with Andreas, to talk a little bit about what private debt means to you and the lens with which you look at it from your side.
Thank you very much, Sachin. My name is Andreas Kalusche. I'm CEO of Prime Capital, which is a medium-sized alternative asset manager in Frankfurt. We fall into the camp of the more specialized asset managers. To us, private debt is effectively a group of fixed income investing assets grouped into infrastructure, real estate, corporate exposure, and then potentially other more specific exposure. It is along the capital structure, so we look at senior debt, we look at whole loan, we look at junior debt, we look at mezzanine, which normally should include an equity kicker somehow. And then on top is equity, which is not the topic here. And the way that we have set up our business is that our private debt teams are separate from our equity divisions, but nonetheless there is, as much as the Chinese walls allow, there is some cross-fertilization, in particular when we are trying to source assets. We are particularly focusing on bilateral situations in our private debt arena.
Thank you. Nakamura-san, would you like to take that question?
Thank you so much, Sachin. Also, everyone, very nice greeting to you. I'm Nakamura. I'm in the Asset Management One Alternative Investment. Asset Management One is one of the largest asset management company in Asia, 460 billion under AUM. My team is same like project. I'm also working for the infrastructure debt strategy. Since 2016, we launched the first fund focusing on senior debt. Currently, we manage 4 funds, accumulating for $1 billion equivalent. So our main investor is an Asian insurance company, also pension fund, also some regional banks. They are having a long-term duration liability, which really align with us. Our fund is a 20 years closed-end fund. So we are now talking about, yeah, I'm happy to talking about infrastructure debt. Also, I'm really happy to be here. Yeah, you're saying that privilege. I'm saying, yeah, I really have a privilege to watch World Cup on live. Thank you so much.
Neo, do you want to take that question?
Wonderful. Yeah, so my name is Neo Mooki. I am the head of insurance and private asset solutions at Generali. I've recently joined, so I'm very new to Generali. Generali, we've got about 25 billion in private debt. In totality, about 80 billion across real assets. Private debt spans a broad range of investments across the debt spectrum, very similar to what you said earlier. We launched the platform, I think it was in 2012, a little bit over 10 years ago, with a fund-of-fund business and some direct lending as well as part of that. More recently, as well as growing our fund-of-fund business, which invests in asset-backed lending, special situations. We also have just launched a direct lending platform, and that's growing very, very well. Our main investor is the insurance company, Generali Group, the general account, but we are also growing our retail business. So I'm very heavily involved with Banca Generali and with the unit-linked business to introduce solutions there to democratize private asset access to those clients, as well as our third-party business. So that's me.
Finally, Joseph.
It's a pleasure to be here. So my name is Joseph Pinto. I joined MNG to lead the asset management business 6 months ago. Before that, I was at Natixis, so it's a pleasure to see a number of faces that I know. It's always good to be here again. So just a little bit of history and what's relevant probably for the audience here. MNG today is a listed company. It used to belong to the Prudential Group. It has 3 business units: life insurance, retail and wealth management, UK clients only, and asset management that I'm leading today. So we manage roughly 350 billion euros, half of it on behalf of the life insurance company, ex-Prudential UK, that became MNG. And that partnership helped us effectively to invest in private markets for many, many years. Today we have third-party clients and we manage the assets on behalf of the insurance, as I said. We have probably more than 85 billion euros in total in private markets, of which 30 billion in private debt. And actually the group has started investing in private debt since 1997. So as a result, today we have probably a broad range of strategies: infra debt, real estate debt, and for sure the traditional corporate credit, both the leveraged loan space, including and direct lending, but also everything related to structured credit at large, asset-backed securities as well. We came back to the CLO market. We issued again our CLO this year, and we expect to do more by the end of the year. And one of the key challenges for us now is for sure to internationalize the investment capabilities, as we were born in the UK, and most of the assets we used to manage were UK ones. And we are effectively on the verge of increasing our sourcing capabilities, working with, let's say, more European banks. So it's a message here, and increase indeed our, let's say, sourcing capabilities within the continent, and be a bit less UK-focused, UK-centric, if I may say so.
Thank you, Joseph. Yeah, I think that really shows how broad private debt is. It really encompasses a lot. We've seen one of the largest shifts in value from equity to debt as rates have risen. Patrick, would you mind giving us your view on the macro environment, and in particular taking a view of how that could affect the private markets with a view of interest rates and inflation?
Yeah, thank you, Sachin, and good afternoon for all of you. Well, I will use these few minutes. I mean, I was given to give you an overview of what I expect on the evolution of long-term interest rates, especially in the Eurozone and Japan, because we have a Japanese guest here, and a lot of you are interested in the Japanese markets, and see how this could affect the fact that private debt could be more appealing or less appealing for investors? What are the advantages, or what are the problems with private debt investment in this environment? So I start with the outlook for long-term interest rates. I think long-term interest rates are a very crucial issue. I mean, if we have in equilibrium higher long-term interest rates, of course, I mean, many investors will be back to investing in very secure commodities, secure assets. For instance, sovereign debt, and for instance, a very safe corporate debt. So it's a very important factor for the investment allocation, for the investment choices, to know where, I mean, long-term interest rates are heading for. So I start with the component of long-term interest rates, which is based on inflation expectations. And I show here the 10-year inflation swap. I will discuss the situation in Japan shortly afterwards. It's a very specific situation. And I focus here on the euro area. And so what you see here is that there is an upward trend in 10-year inflation swaps, in long-term expected inflation in Europe, where it doesn't show up in the US. In the US, you just a slight downwards trend for a long-term expected inflation. In Europe, you see the blue line. Long-term expected inflation is creeping up continuously. And I think all the inflation forecasts done by international organizations, including the ECB, are very much underestimate the risk of keeping a very much higher level of inflation in the euro area. For instance, if you look at the latest forecast done by the ECB expects a very large recovery in productivity, which is very improbable, I mean, unlikely, because productivity in Europe has been completely flat since 2017. The ECB expects a big reduction in oil prices, which is also very, very unlikely because of the new behavior of OPEC countries, and especially of Saudi Arabia. So if you correct for that, if you plug in a decent estimate of future productivity gains and a decent estimate of oil prices, you end up with an assumption that inflation in the euro area will be around 3.5% at the end of 2015, and not 2% as the ECB is telling us. So this means that probably inflation, long-term inflation swaps will continue to come up. And I think just a remark here, if long-term inflation, if 10-year inflation, if 5-year inflation swaps come to a level of 3%, it would be absolutely costless to change the inflation target of the ECB, because the ECB would have lost its credibility, and the markets would believe that it's only able to bring inflation back to 3% and not to 2%. That's a very hot debate amongst the European economists. So let us assume that long-term inflation swaps come to a level around 3% in the future, which is 30 BPs more than today. Then you've got another component of the that's the US of real long-term risk, which is based on the differential between national investment and the national rate of investment and the national rate of savings. We know that for energy transition, for the sake of the necessary investments in the management of water, to keep a sufficient amount of biodiversity, we have to invest a lot more. A common assumption is that Europe and the world basically will have to invest 4 points of GDP more for the next 25 years in order to achieve, I mean, energy transition and these other transitions. If you look at the level of savings and the level of investment in Europe, investment is already catching up with savings. There is no current account surplus anymore. I mean, and we'll see that even more in the future. The necessary level of investments which we have to do, I mean, for the sake of energy transition and the other transitions, will keep going up, and we will end up in a situation of insufficient savings. And if we lack savings, if we need to do more investments, that we have savings at a world level, it means that the real rate of interest, the long-term real rate of interest will increase. And if I'm back to the long-term real rate of interest, you see here, I mean, in Europe it's still very low. It's about 0.5%. In the US, it's higher, but if you look at the past, we were used, I mean, before the subprime crisis, to having a real long-term interest rates at a much higher level, around 2%. And I don't see why we would escape our real long-term interest rate to be back around that level of 2%. Again, we'll exit from a world which is characterized by the famous savings glut of Ben Bernanke. We had until 5 years ago, we had more savings than we had to invest at a world level. Today we end up with not enough savings to balance our needs to invest more. So let us finish this calculation by calculating by calculating my assumption about the future of the 10-year interest rate on European swaps. I mean on swaps on euro. You see that today, I mean, a 10-year swap rate is around 3.30. I add up 30 BPs from the increase in long-term inflation, and I add up probably at least 50, 60 BPs from the insufficient level of real long-term rates compared to the needs for more investment. So I end up with an assumption that the 10-year rate in Europe will go to around 4%, which is very close to the current US level. So it's my first question. Do real debt assets, how will the real debt market react to a further increase of long-term interest rates? Can the real debt perform the same with 4% interest rate on sovereign debt in Europe? And the further increase in long-term rates, can it trigger an increase in default rates? Can it trigger a further decline in property prices? And that are the main questions behind. Just before asking more precisely this question, just a word on the case of Japan. The case of Japan is extremely different. In Japan, the only question is when will BOJ forget about the yield curve control and forget about zero base rates. I mean, this is zero base rate policy. It has been pursuing for close to 20 years. I think if you see the debates inside BOJ, and if you see that the inflation in Japan is around 4%, and it's more than 3% wage inflation in that. It's very unusual in Japan. The collective wage agreements in Japan were done at close to 4% last year. So it's the first time in 25 years that the Japanese trade unions end up with a significant increase in wage growth. I mean, and they obtain that from the corporate sector in Japan quite easily. So inflation in Japan will be a persistent inflation around probably a level of 3%. It's very hard to keep a target for a 10-year rate below 1% and a zero base rate target when inflation is around 3%. This is creating a lot of biases. You see that we in this case, Japan would have extremely negative real rates, and that would push up property prices. That would create a lot of distortion in the economy. So I'm pretty confident that progressively BOJ will switch out of this policy, will start increasing the short-term rate, will widen the bracket, I mean, and widen the difference between, increase the possibility that you end up with higher long-term rates. My personal calculation is that in equilibrium, if there was no central bank intervention, a 10-year rate in Japan would be around 1.5%. So there is about 70, 80 BPs to go when you get to that level, which probably will done during the course of next year. Just a final word, Sachin, on just a question, some questions about private debt investments. Of course, you've got a number of favorable aspects to private debt investing. Valuation is more stable, you mentioned that before, than on public debt markets. Private debt is less risky than private equity. ESG constraints are much easier to introduce in private debt contracts. You got high alpha on private credit. You get 7 to 8% returns, and you get a very large private debt market. You emphasized that before. But you've got a number of unfavorable aspects. I mean, we'll keep higher returns on government debts or investment grade debts. In Europe, I mean, I think that the level of 4% on government securities will be probably a stable level over the long run. I mean, I don't see interest rates going down because there will be more inflation. Central banks will have a tighter monetary policy. There will be the costs of investing a lot in energy transition. I mean, there will be the cost of the inflation caused by relocations to Europe of strategic industries. So you will have more investment, more necessity for the ECB or for Bank of England to be more restrictive. And so I think that a 4% return on government debt is probably an equilibrium level. So you will have, again, decent returns, for instance, for insurance companies on government debt. And you've got default risk, and currently appears, especially on corporate or property debt, you see a very rapid increase. This is more short-term, of course, but you see a very rapid increase in high-yield defaults, high default rates in the US, which will spread to Europe and which will affect all high-yield assets. I mean, and this is probably unfavorable for a segment of private debt. Of course, it doesn't affect. I mean, infrastructure debt. It doesn't affect the IG component of debt, but it may have an effect on specific segments of the private debt markets.
Okay, no, that's very interesting. Thank you for that, Patrick. I mean, perhaps any reactions from the panelists about what Patrick said? I mean, his theory about rates being longer and the impact that's going to have on the private debt markets. Do you guys have a view on that? Maybe Joseph?
Yeah. I like the favorable aspect. The list is long and it's positive. No, but more seriously, indeed, when we speak to institutional clients today, a lot of them have affected much more assets into liquid than private. It's, no one can dispute that. Look at the fundraising. The assets raised in the private debt, let's say, area have slowed down. It's still very positive, but nothing to compare to 2-3 years ago, how much it was. That's effectively point number one. Now, having said that, yes, once you've captured nice returns on the liquid space, you can still have the illiquidity premium that some of the institutional clients can capture. At least the one who have not been caught to actually what Mohamed mentioned before, the denominator effect. Mm-hmm. For those who have been affected by it, they are stuck with it and they are looking for liquidity. We're probably going to talk about it in a moment. The second element to it, which is I like actually also your unfavorable aspect, happy to talk about it. The risk of default, especially on the private, let's say, credit side, on the corporate side. Well, when you are a private lender, you have the chance to do a proper and thorough due diligence, and you can try to avoid actually that risk more than what you can do on the liquid space, depending on how you invest in the liquid space. That's obvious. So that's something that if you are a strong asset manager with alpha generation, you'll pay attention to and you will avoid that default that does exist, absolutely, and you have a way to avoid it. So you still have some resilience on top of the additional expected return that it makes the case positive. On property, just a word on it, on real estate debt, what we have experienced discussing with clients, it's indeed because of the devaluation of the property, at least started in the UK, minus 20% at least. I think Europe, it varies from country to country, but it's closer to 10%. Well, you know, when you sell, you know, real estate debt products, be senior or mezz, there's a very nice return. You can go on gross returns on mezzanine between 10 and 14%, depending on the type of paper. And because of the devaluation of the underlyings, the assets themselves, you have less of a risk to some extent. So it's not as risky as one could believe, unless you believe that there will be a massive crash on the property market in the coming 2 years. So there are cases where you can see effectively positive cases why investors, when they have the space, should still invest in the area.
Thank you. That's very interesting. Your first point about liquidity, I think, is definitely something of interest. So perhaps just delve into that a bit more, Joseph. Have you been able to find the liquidity you need to rebalance your portfolios? So obviously the denominator effect has been a very prominent effect that we've seen through this year, but have you found that liquidity? And we've seen, and I think we spoke about it earlier, a number of solutions in the fund finance space where the ability to kind of raise secondaries financing to kind of help a bit with the liquidity for illiquid assets. But have you seen other strategies at play that have also helped you from an M&G perspective?
So on the liquidity topic, well, I've asked the question. So as I said, we also manage the asset of the balance sheet. I did ask that specific question to our CIO on the insurance side. He was very pushy on it. And he said, you know what? Don't put yourself in such a situation. That's what asset allocation is about. You need to anticipate. And I told him, well, not maybe everybody's as clever as you are, but we do speak also to external clients who've been caught by the denominator effect and have been facing some liquidity issues. Well, two possible ideas when we've been talking to them. The first one is to review their guidelines and to what extent they can enlarge, let's say, the risk guidelines, if the risk management department accepts them, at least temporarily, not to become forced seller. Or the second one, eventually, effectively, is to turn to the secondaries. We've talked a lot in the industry about private equity secondaries, but if you look at the evolutions of the private debt secondaries market, it's been increasing quite significantly. Now, it's a matter also of price, and to what extent, if you are forced to realize, you want to incur such, let's say, a discount to access the liquidity. There are obviously also more liquid assets within the private debt space, including ABS, so it depends on how the allocation is. But at the last resort for the long-term investors who are forced to have access to that liquidity, it's the way that we've experienced in the market.
Thank you. It's very interesting. I think in a challenging market, there's also a way for managers to differentiate themselves and actually really show that they can add value to their clients. Perhaps Neo, talking a little bit about opportunities that you see in the market on your side. One thing that I think will be interesting that we spoke about is I think in your previous role helped to bring insurance capital to different segments of the private debt market. But perhaps you can give some examples around that. I think that'll be interesting for the audience.
Yeah, I think I'll first of all comment on what you've just said around the denominator effect. I think it's important to know that for most insurers, I think they're actual LDI investors. So a lot of them haven't actually been caught by this because they're LDI investors.
So you mean that the liabilities have gone down as well as the assets?
Absolutely. So we are more interested in absolute income and in cash flow match than we are in benchmark weights, right? But obviously, we've experienced a lot of lapses. I think everybody knows that. We've experienced lower new business, and that means that we've not had that much flexibility in terms of rebalancing as much as we've had. So we are allocating less. But Generali, unlike our peers, we are hugely underweight alternatives. So we're still looking to allocate. Private debt is an area that is of strong focus for us because we still see it as it gives a lot of value from a relative value perspective. It's a growing asset class. There's lots of opportunities. It's an inflation hedge, and more importantly, it gives us that valuation stability that you talked about earlier. So I think for insurance companies such as Generali, private debt is still an area that we are allocating to. In terms of relative value or sort of areas where I think we will continue to see value going forward or assets flowing into private debt, I'll touch on some of the themes that you touched upon earlier. So one of the big macro themes is reshoring and friendshoring. And because of that, I believe that we'll continue to see a lot of capex lending coming up in the short to medium term in Western economies, and this will also fuel asset-backed lending as well. Another topic that's been touched upon is around ESG and the commitment that a lot of insurance, pension funds, asset owners have made. I remember this in 2020, I think it was during COVID, everybody was making this leap of faith, making these big commitments to net zero. And this is going to continue to be a big driver in terms of especially being supported by governments who are passing legislation to basically support the shift towards green investment. So this will be an area. So for us as Generali, in terms of what I'm looking at with my team in terms of areas of growth is making sure that we are including these thematic investments that will continue to see headwinds in this sector, particularly because we are making a big push in terms of democratizing access to private assets. So for our retail clients and our banking clients, that's a huge market for Generali in France, in Germany, in Italy. We are a household name. And if we can nail this, because these clients are values-aligned investors, this will basically offset some of the outflows that we're seeing on the general account. And obviously blended finance facilities is a new feature that we've seen. And I think if we can get this right, I think we might actually be able to unlock the trillions that are needed to basically continue to fund the transition to net zero. We talked about a continued tightening of bank lending standards, which is obviously also creating opportunities for non-bank lending. And we talked about this earlier. You know, the interesting thing about this is everybody's talking about this now, but this is not a new phenomenon, right? The impetus for us to move into lending came from the banks themselves actually pulling out of direct lending and specifically cash flow lending. And obviously this opened up space, and my view and our view is that this will continue to be as big a theme as, you know, the shift towards climate solutions is. And this actually creates opportunities, and this is where fund finance comes in. I honestly believe that there is no new innovation. I think it's all about taking various components and actually structuring them into solutions that meet client needs. And this is what happened with fund finance. It is areas where banks dominated and there were no institutional clients in that space. And I had a client who had just survived Solvency II, and we had to de-risk. We had billions sitting in cash and gilts, and my client, I think is the biggest insurance relationship in Europe, and he was saying to me, Neo, what are we going to do here? We can't sit on all this cash and gilts, and we checked the cupboard, and there was nothing. And thankfully, the relationships that we have with the banking industry brought this various solutions across to our desks, and I saw something, I was like, what about that, right? You know, and then the lady said to me, no, Neo, that's just for banks, sorry, I shouldn't have put it in the pack. And I was like, no, but that looks really interesting. And that was the beginning of actually introducing an asset class that institutional investors, specifically insurance clients, were not previously exposed to, bringing it into the institutional world. It wasn't my team that did it. I will not take credit for it, and this is where I bring another point in terms of, you know, what is actually driving innovation, what drives relative value. Apart from banks moving away from certain areas, and they will continue to do that because banks are going to start to look at certain areas, and in an era where you can pick up the phone and move your deposits very, very easily, obviously the stability of the bank's capital has changed dramatically. So there will be areas where banks are going to think, actually, this used to make economic sense. It doesn't make economic sense anymore. Healthcare receivables, fund finance, asset-based lending. But the point I wanted to make very, very briefly to end is what brings innovation isn't just one party. What we've seen, and I think somebody alluded to it earlier, I think it was the gentleman who introduced earlier, the sophistication of clients. Clients are increasingly sophisticated. And it is because of this, now you have clients who are affected by the prudent person principle in the UK. Mm-hmm. I think it's a different form in Europe. They engage with these asset classes with a view of really kicking the tires and understanding what we are actually building in terms of solutions. We're not going to win if you're just producing product. It's all about identifying these areas that are opening up through banks actually peeling back from the space, and then working with different parties, not just the banks, asset managers, banks, and clients. And that's how fund finance was actually, a success, is because I worked with the bank, asset manager, and the client, and also the PRA to actually co-create something that was actually acceptable. So, yeah.
So that's very interesting. I didn't understand it was so serendipitous, the actual evolution of that. Disintermediation is definitely a key trend. We really see that on our side. I know on Emmanuel's panel later on alternatives, they're really going to drill in on that. It's a trend that's really going to be around for a long time. And I think that's where at Natixis, it's been quite interesting where we're positioned to be able to take advantage of working with different originators and different parties around Europe and around the world to be able to source interesting products for clients. Maybe moving a little bit onto the regulatory side, Nakamura-san, I know we've seen some very large moves in regulation which have enabled insurance companies and pension funds to access the private debt markets. We see that in one of the largest pension markets in Europe, in the Dutch market. We spoke a bit earlier on with Joseph about the UK and the Edinburgh reforms, which are meant to make meant to make more flexibility for insurance companies and pension funds to kind of access the market. From your view, kind of in Japan, like, do you see a kind of similar drive for governments to allow to unlock Japanese or kind of Asian capital to invest in the private debt markets?
Yeah, for talking about the regulatory requirement, yeah, definitely it's really played quite functional role in our business. So yeah, our infrastructure debt fund, there are a couple positive factors regarding regulatory framework. So one is for investor side. I think she already mentioned our main investor in Asia is an insurance company. They now try to catch up the solvency requirement which means our infrastructure debt is possibly qualified for that. In the case, so they can enjoy capital relief. Our strategy is only senior debt. Returns are very humble, honestly, like a 2%, 3%, not like other private debt, like 8 or 9%. But one thing that, definitely, Japanese interest rate is really low, zero policy. Then they are looking to alternative bond investment. So still 2%, 3% really justify. But also, if you are talking about risk-weighted basis, if you are taking account a capital relief, 2% really a good positive factor to insurance company, also regulated body. So in a way, still Asian country, we strategy like a senior debt only strategy still works. But thing is that right now interest rate is taking leaves on the ground, maybe increasing. We see the other strategy coming on. Maybe meanwhile still on the senior debt strategy still works on. Then second is sourcing side. So we are debt fund, so we do not participate in the primary deal. Mainly participate in the secondary market to acquire the deal from the bank, either some other institution. So we definitely need a dynamic movement in the secondary market. Otherwise, we can't deploy the money. So that was really jeopardize our returns to investor. So one of the regulatory is Basel. It really affects the bank balance sheet. Bank is happy to originate the project finance is an infrastructure loan, but happy to distribute to the market. But look at these asset classes very niche or very private. They don't much have a buyer side on infrastructure debt. So we don't want to jeopardize bank business. We are in a kind of buy side, just for sell and buy. Then we are happy to collaborate each other. That's going to be business model. Then third one is that maybe I really want to hear it's a mainstream of regulatory work, like a U.S. infrastructure law. Also in Japan, we have renewable infrastructure law that's really incentivize the project in the market. But it's really incentivize a new project, also aim to the decarbonization in the mission. That's really help in the market. But as for infrastructure debt, there's not much space to play these days. Honestly, these markets are quite occupied by the equity, either traditional bank loan, because there are so much liquidity in the market. These new projects, these new greenfield is really occupied them. So in a way, so the third main regulatory pushback, like infrastructure law or some sort of bigger picture, is not much appealing to us as of now. But we'll see in the future, maybe they have some funding gap. So that's the timing to our investor or institutional investor to participate in the deal.
Thank you. That's very interesting. Maybe Joseph, like looking at it from a UK perspective, and I think at M&G they're part of the asset management task force. Do you see some drives from the UK regulator or the UK government to kind of try and make it easier to allow asset managers to facilitate the inflow of capital into the private debt markets?
Yeah, indeed. Effectively, in the UK, there have been a number of initiatives to try to incentivize long-term investors to put more money into the private asset. I just want to say, because you've been asking me question on the UK, that this country here in France has done it 3 years ago already. It's called the Loi Pact. So UK government, what they've done is effectively ask the DC pension funds, they incentivize them to put at least 5% of the assets into private markets. That's one element that we've seen. The other topic that we've been discussing on through the Asset Management Association, the IA and the FCA, is indeed how technology can help as well, somehow create more liquidity in the market, democratize private markets, and the topic of tokenization has been on the table. And it is true that a number of countries, including France, Switzerland, Singapore, are probably at the forefront of the topic. And it is true that if we can tokenize, the data area, it will help first reduce the cost of transactions and to provide accessibility of assets to a greater, let's say, set of potential investors, including retail clients. Now, one has to be, realistic. what effort needs to be done to reach such an objective. First, investment in the technology and make sure we have the right business case behind. And two, scalability. It's always been the case in the banking and asset management industry. Size matters, and being relevant in many countries, it's even more important. So which means that regulators across Europe, to start with, have to speak each other, to have a sort of a homogeneous regulatory framework. You know, when we are based in the UK, our asset managers are here in the are there in the UK. We will use an Irish vehicle eventually to promote those strategies in continental Europe. So you need to have a form of homogeneity, a bit like AFM provided years ago, or even UCITS many years ago. That's for sure the key challenge to allow, let's say, accessibility to greater people and facilitate investment in the private markets.
Thank you. No, very interesting. And picking up on your point about size and scale, that's one of the things that we were also talking about in the fundraising context. One of the things we've seen is that it's definitely been a challenging fundraising environment, and generally the larger managers have probably seen a greater inflows than some of the more specialist, smaller managers. Maybe Andreas, you've just recently gone through a fundraising round on your side. Have you found it challenging? What are some of the ways you've found to kind of overcome those challenges on your side?
Thank you for the question. Maybe if I can come back to the last point very briefly. Even in Germany, there are some initiatives that allow certain institutional investors to put more capital into infrastructure-related assets, be it equity, be it mezzanine, or be it debt. And there are a number of associations working very hard with the government in Berlin on explaining what is required, that not Ontario Teachers' Pension is financing German assets or large foreign external managers, but that German pension and German insurance money can fund the huge investment requirements that we have on the infrastructure side. So we are a little bit behind, if I hear what Joseph has said, in comparison to France.
He's just biased to France, that's all it is, yeah.
Okay. We're a little bit behind France and UK again when it comes to financial services, but at least I think we are listening. When it comes to fundraising, clearly we are not a large player. We have 12 billion assets under management, and I can only echo what Joseph has said. Fundraising has become tough since beginning of third quarter last year. Personally, it feels like we are, at least in the asset class of infrastructure, we are fundraising in equity, in junior debt, and in infrastructure senior debt, so in 3 different strategies with 3 different teams. Frankly, we have very good conversations, so hopefully we are getting through the bottom now, but it has been relatively challenging. And there's very significant, I can only echo what you said, there's very significant M&A activity happening in the asset management industry. Latest transaction, CVC buying DIF, that is clearly echoing or demonstrating what you have said, that asset managers in general are trying to add in the current environment expertise that they potentially do not have, or real estate looking into infra, or private equity looking into infra. Infra is very often part of this game, I would say. We are still continue to position ourselves as a sort of as a gateway, as a facilitator of a sort of a translator of relatively new asset classes like infrastructure debt or real estate debt. It's still relatively new, effectively only post GFC. It really has become visible, as far as I can tell, on the continent. And we still try to present ourselves as a facilitator, as a translator, and obviously then as an asset manager, building track record, adding people. And we are trying to be to exploit our nimbleness. So when it comes to Germany, Germany as a country is very differently structured to France. It's a very federal state. Wealth is distributed all over the country. Economic activity is happening all over the country. So it's relatively difficult if you're a Japanese or a Korean or an Israeli investor to get your grip on Germany. So that's what we are trying to position ourselves. And also,
so it's really trying to show that you're a specialist manager and you have some unique kind of like differentiation skills to be able to access the local market, basically.
Correct. That's what we are trying to do. And then and sort of another thing that we are have become more nimble of. When we talk about investors here on this panel, we are effectively talking about insurance and pension fund. Simply said, Solvency II investor or thinking along those lines. There are obviously other investor groups, like family offices, look completely different to the world. They are real yield investors, not nominal yield investors. Banks, saving banks, is a very large sector in Germany. They follow CR2, shortly CR3, very different regime, very different dynamics. Banks are very strongly benefiting of the interest rate development. The interest rate margin is increasing significantly. So that's a differentiator. And it's these kind of things where we have also by adding additional distribution, business development people, trying to become more nimble and work harder in our core markets, and then adding this gateway international concept to us. And with that, we hope to survive.
No, very, very interesting. I know we're running out of time, but perhaps we had one topic, and I know we're going to be talking about that a bit later on the ESG side. We thought we could kind of introduce the topic a little bit on our side. And Patrick mentioned that private debt is one of the ways in which you could help or facilitate the energy transition. So perhaps it's an open question. Do we feel that like the kind of like investors will keep their commitments to ESG, especially in a more challenging environment? Maybe Neo, I know ESG is something very close to your heart.
I think investors will. Firstly, because the sort of governing documentation sort of for both equity and debt is going to force them to stick to them. And I think partly as well for selfish reasons. I think as we talked about earlier, you know, ESG, climate change, net zero commitment, people have made commitments and they are being held, their feet is being held to the fire to basically make sure that they meet those commitments. So I think investors will continue to stick to those commitments in order to be able to benefit from all the flows that are coming into the space. I know that we are, as I've said, in terms of innovation, we are very, very clear. You cannot have the best investment team, the best product development guys, but if you're not making products that are aligned to what your investors are actually wanting to put money into, then you might as well close shop.
I would agree to that, and at least an observation from our company, our average age is 35 years, 36 years. It's coming bottom up. There's very significant push from the younger workforce, which is gradually moving up to middle management, is asking and challenging E, S, and G on all three different fronts. They're challenging us more seasoned individuals in the board, including the supervisory board. So with us, it's a pretty big push, and I find it, quite frankly, pretty energizing. It's interesting, and I would agree. It's not going away. It will continue. It will become larger. I would every young employee, I recommend to put as much focus on ESG education next to its normal private debt analysis or controlling or tax work as possible.
And then can I mention one tiny thing? I think because we also invest in funds, so we have fund of funds. 10 years ago, when I was a lot younger, when we were engaging with GPs, there were some GPs who would even refuse our money because they felt that our ENS requirements were too onerous, they were too stringent, it's just too much hard work, and they would refuse our money. You're not seeing that nowadays. So it is not just coming from investors, and as you say, the young, up-and-coming employees, even the toughest investors, GPs, the top GPs, the smallest GPs are also responding to this. So it's here to stay.
Interesting. Nakamura-san, I think you were going to say something as well.
Sorry, yeah, I think the ESG is a quite different view from the equity and debt. Equity perspective, yeah, it's really opportunity. If you chase the ESG properly, you can gain upside. That could be an opportunity. But as for debt fund, we don't have any upside. We just pay down the interest and predetermined principal. In a way, in a view for ESG, it's of course it's a main purpose, but look at the downside protection, also risk mitigation. We're really focusing on ESG. So, but it's like kind of in the future, there is some impairment in the loan, or is there any possibility of default? We really want to avoid that. In a way, ESG really does works well. Of course, we are corporate-wise, so ESG is really important, but risk mitigation-wise, yeah, debt fund, ESG are quite vital.
Interesting, thank you. So I think we've run out of time, actually. We've come to the end. We have a few minutes left for questions, I think, Christina.
Indeed, yes, indeed. Thank you very much. A great applause to you first.
Thank you.
Do we have any questions? We have our hostesses who can actually give you a microphone. Don't hesitate to raise your hands. Well, apparently it's clear. It's always the first question that is hard. So let me ask the first question probably to you. Joseph Pinto, how do you see the emergence of new technologies like AI affecting the asset management industry?
That's the topic of the day that every board is asking us. So I'll give you a very short answer on this one. Yes, AI is affecting our industry as much as affecting every industry. We have to embrace it, not to be afraid of it. It will increase efficiency in various departments, to be frank. It can also help our portfolio managers in the way they manage, the way they do their research, so on and so forth. The question becomes is, how do you apply it in our companies with our old processes, and how fast we can adopt those new technologies? That's what we're working on as we speak. We've launched a number of proof of concepts, or pilots as we call them, and hopefully with positive results in few months. It is a bit scary, one has to say, when we look at statistics, exchanging with peers, exchanging with the industry, like even the asset servicing industry. You take a department, I don't know, like marketing or the RFP department. We have some of our competitors that shrunk the size of their RFP department from 30, 40 people to 5. The rest, AI. So it's positive for sure for the shareholders, because you are much more cost efficient, but we have to do it in a, for sure, progressive manner.
Great. Do we have any questions from the audience? Well, apparently you were extremely crystal clear. No questions. So probably one last one for you, Patrick. When are we going actually to see the yield curve getting back to normal?
Well, probably you are speaking of the yield curve in the euro area. I mean,
yes.
I think the ECB still probably will hike rates next year. I mean, they will pause for a couple of months because they want to see the effects of their policy on inflation. But the level of rates in Europe is too low. I mean, we have a 4% deposit rate compared to a 6.2% core inflation in Europe. I mean, and so probably this requires a further tightening of monetary policy. So the yield curve will stay inverted as long as the ECB doesn't start cutting, and I don't see that before probably the middle of 2025.
Thank you. Any additional questions from you, dear audience? Yes, we do have one question. Great.
What is the panel's view on the transparency of reporting in private debt? So as private debt has grown, and at the same time, regulators are saying, you know, more and more transparency, right? We want more transparency for investors. How do you sort of bridge that?
Can I take that? Can I start? Yeah. It's a very interesting topic, and I think from an insurance company's perspective, it's not a choice. We don't have a choice. We are required by law to have looked through funds through to our portfolios. We absolutely don't have a choice. So, and I think it's a very important question because it touches upon one of the themes that I always kind of mention to my teams as well about innovation, which is that when people are talking about innovation relative value, we forget about infrastructure. Probably for all of us, 50% of our firm's money is actually spent on infrastructure. By infrastructure, I mean making sure that, so you can have the best investment teams in the world. However, if your deals are going to fail on the operational side, on the accounting side, on the reporting side, and you're not able to communicate to sophisticated investors clearly in the required timescales, you will not grow. So I think that companies, asset managers, anybody who's looking to manage it, you don't have a choice. We just have to comply. It's important to invest in infrastructure. That is part of being able to be an innovator.
I think another point, it's actually a great question. One of the reasons why private markets are better, quote unquote, for investors is because they get much more timely information if they get it properly presented by the data provider, by the asset manager, and so on and so forth. But the opportunities to look into a stock-listed company truly in detail and adding some script, some framework around if you are not happy with a certain decision is exactly zero. Whereas in private debt, let's stay with this example, you can put all sorts of covenant in that. Let's take real estate debt. We are a real estate debt investor as well. We have also provided loans in project developments, also with higher LTVs, and it's a war zone, quite frankly. But not only since beginning of the year, we are providing updates on the relevant assets on a monthly basis. We're doing this much, much longer. Project development always was, for us, the requirement to provide very timely, and to us, we translated this monthly updates. And the last point is people. The biggest issue that we have, when we talk about the private debt market grows and it's all good and good, yeah, fine, but we need people. We cannot hire quick enough out of banks or other organization, people to come on board. So we need to train that. And the asset management industry in general does not have a good reputation of building people themselves. I'm also a board member of the Association of Alternative Investments in Germany, so I'm involved in a couple of these topics. And banks are doing a great job educating people, insurance companies are doing that, but we, on the asset side, we have borrowed or hired from all sorts of spaces. So it is, whilst we want to be very transparent, and we want to be more transparent than the listed market, we need to get the information, we need to digest it, we need to present it, we need to put covenants around this information, and it's ongoing. It's ongoing, it's evolving. Hopefully we are getting better each day, and as an industry, there are some data providers, some databases helping us. Yeah, it's something that we feel obliged for, quite frankly. This is one of our raison d'etre. We have in, I don't know, our equity funds, we have 14 positions. In our debt funds, we have 30 positions. That is feasible if you have built a bit of And if you have a couple of funds, I don't know, you have made 100, 150, 200 positions, that is feasible if you build up a proper company and then really drill deep. That's my view.
Yeah, I think I just want to add on some comment on transparency in the asset management company. Yeah, definitely, we want to disclose individual project, individual investment, because it's like a requirement by look through, otherwise you're gonna be penalized. So, but the private asset is gonna be really private. Some of the information really private, we can't disclose because of confidentiality information that close. But we try to best. But I think the investor much more focusing on the valuation side, not on the individual project. They really want to see some transparency in the asset management company, how to evaluate the asset individually. That's more important requirement for the transparency wise. So that's why we are really focusing on justification of our valuation policy. Also, I think that Martha is now on the valuation side. That's my comment.
Well, thank you very much. A great applause again for our dear speakers.
Thank you, Christine.